With me, I have Mr. Bharat Shah. He's the executive director at ASK Group. So he brings about almost 3 decades of experience on the table. I would say that one of the rarest mind for equities as an asset class and overall capital markets in India. So very unique approach. Always been very vocal about certain things which he may not like, and being very fearless about sharing his perspective with everyone. But in last 3 decades, when he took over ASK, when he moved out from Aditya Birla Sun Life Mutual Fund as a CIO, when he was working there and joined this group, he has played an important role in terms of shaping up the organization and have been instrumental in terms of defining the various investment philosophies and various framework in which the entire investment committee works, and they all of them work very closely, and not only at investment AMC level but also across the group. There are other businesses which ASK runs, like real estate or wealth. There also he would kind of share his guidance on what is his reading on those businesses. So thank you so much, Bharat sir, for accepting a request once again. And my first question on behalf of our investor is that everybody is curious to know your views on the market first, and then we'll come to other questions, sir. Over to you.
The short answer and then a long answer. Short answer, I have never been more positive about India as a country. Indian economy is a growth economy. Performance and the evolution of the businesses within the economy and their future. In turn, the value created by those good and quality businesses, and in turn, opportunity for disciplined and wise and long-term investors to build value of an unprecedented type. So, in my 35 years of investing career in this country, uh, and 35 years is long enough for one to be cynical enough in life, because age brings in that cynicism about many things. But I feel a childlike glee, a childlike delight at the prospects of this country, her economy, her businesses, their value, in turn, the values of the portfolios of investors who are wise, disciplined, and long term. You see, there are not too many economies in the world who really have depth or character enough to be able to build gigantically large value meaningfully for a length of time. At one point of time, if you would have asked me that question, I would have said probably 5 countries which have that potential: America, India, China, Germany, Japan. Today, I'll safely drop Germany. Today, I'll drop Japan, even though recently Japanese markets are at least somewhat improved. And I would say China is doing enough to destroy itself by its own actions. And therefore, really, the game is between India and America. Why am I saying that very few economies have depth and character? Because ultimately, value creation of a sustained nature, of a large enough size, can only come from economy of depth, diversity, and size. Therefore, no matter how good Taiwan is, but Taiwan can't grow beyond the point. No matter how rapidly South Korea has become a prosperous country, from a low middle class to kind of successful economy, probably the fastest in the economic history. But South Korea has reached its limit long back and cannot really go materially larger. Country like Japan, with wrong demographics, very status quo is mine, non-entrepreneurial talent. Talent is not entrepreneurial in Japan. It is mostly working for Mitsubishi's and Hondas and Toyotas of the world. Japan has lost a game, and Germany also could have done it, had a potential, but is destroyed that potential because, again, non-entrepreneurial mind, very manufacturing centered, and within manufacturing, largely automobile and thereabouts, and kind of a narrow base of the economy. Therefore, even Germany has lost. Very, very few countries can really grow economy in a diverse way at a meaningful rate for a meaningful length of time. And within that economy, market economy has to be sound so that growth of economy converts into market returns, which China as an economy had a potential, but it has proved that it is not a good market economy, and therefore it has destroyed its stock markets and capital markets. Therefore, very, very few really countries have depth and size and stature and character to grow at a meaningful rate for a meaningful length of time in a predictable way with a right quality and which is a right kind of capital market and ethos and structures around that, whereby the growth of economy converts into stock market and capital market outcomes. In my opinion, India is at a point where it is at an unmatched journey, and on this, I can actually shed more light by comparing America, China, and India over last 30 years. But I'll skip that for the moment. Maybe later on, if somebody wants to raise a question to illustrate that how that economic growth does or doesn't translate into market returns. But it's a very powerful analytics of where the situation has been over last 3 decades. I believe, so I'll take it up later if there is interest in that. But I believe we have today raised the game as a country, and we have embarked upon important, major, deep economic changes which create fundamentally structurally strength for a long period of high growth, predictable growth, and qualitatively sound growth, which is capital efficient growth with a superior return on capital employed, superior return on economy, on equity. And with the growth, actually, the leverage of the businesses, the debt equity is reduced. Therefore, I feel the coming not just 2 years or 5 years or 7 years, but I think 10 years and 15 years and 20 years, if not more. This is the period when India will really, really shine out. India is economy, India is businesses, India is stock market, and India is capital market returns. I think it's a dream period, and I salivate almost. That is the kind of attraction I feel, and the power of that is not merely high growth, but durable growth. And that is even more important than just the high growth in a short period. High growth in a short period doesn't do as much. Low growth for long period also doesn't do much. It is higher growth, but for a durable period, backed by quality, which does the magic. And India is at that magical moment. Higher growth, durable growth, and qualitatively superior growth. That trinity is unmatched, and that's why I believe we are at a cusp of greatest economic expansions and one of the greatest phases of value creation in the markets of the country.
So I have goosebumps when I'm talking to you, sir. As I said, listening this from you is really because we all come from humble background. I remember last time when I was speaking with Madhu Kela, he said, because you want to see the growth of India, you go and count the number of trucks which are there now on highways, and then you get your answers. And similarly, when you talk about, the structure, the characteristics which is required for economy to grow for long, long period of time is all there in India. And because we come from very, very humble background, when I hear this from you, and last time I told you, if you remember, that it gives me different perspective and energy altogether. Now I want to pick
Thank you
your
for
mind.
those kind.
Yeah, thank you
Thank
so
you for
much.
those kind
Yeah,
words.
thank you. So I want to pick your mind from because there are other investors also who are there on the call, and they have sent me few questions which I need to ask on their behalf, if you allow us. I want to pick your
Be-
mind on the valuation side, because last time when mid and small cap peaked out, it was 2008 Lehman Brothers crisis. Then again, mid and small cap peaked out in 2012, 13. Then again in 17, when it was trading at 30 ka P, and we see the similar situation now in last 6 months, particularly. Want to know your, if you can, throw some more lights on that.
Oh, I keep hearing these views and opinion in media elsewhere, but honestly, I do not subscribe to it. I do not believe that valuations have gone bizarre or out of turn or in a territory which is reflecting red flesh kind of a situation. I do not believe that. I think people are underestimating the kind of growth that the economy will witness and the businesses will witness. And people probably are underestimating with a near term bias that this growth will prevail for a longer period. And therefore, logically, higher growth and durable growth has to have a higher valuation. It is purely mathematical. Ultimately, valuation is an outcome of three factors: rate of growth, durability of that growth rate, and the quality of that growth rate. These three factors decide the value. And all the three factors, in my opinion, are we are standing at the best point ever in the history. On a more sustained basis, real GDP will grow between 7 to 8%. Nominal GDP will grow at more like 11, 12, 13%. And good businesses within that will grow at 15, 16, 17%. I mean, that kind of a sustained growth does the magic of compounding. Secondly, when growth is predictable and not a chance, when it is not an accident or a happenstance, but structurally predictable, durable element, it acquires automatically higher value. Why? Because anything which cannot be predicted for a longer period is uncertain. Uncertainty means risk, and risk means the value of that business reduces today in the eyes of the beholder. Anything which is looking less certain or more risky would have a lower value, because you increase the discount rate at which you are valuing the future. And when you increase the discount rate for the future, value today comes down. Therefore, again, that is mathematical. The predictability of the growth improves the value, and that probably fact is less appreciated when valuation comments are being made. Third is the quality of growth. Quality may not be seen, it may appear intangible, but it is a real factor in driving the value of the businesses. Quality reflects in form of superior return on capital employed. That means ability of a business to grow at a high rate without capital dilution. Superior return on equity, which is a direct barometer for value creation for the equity shareholders. It may reflect in form of reduced financial risk by meaningfully low debt equity ratio or low gearing in the businesses. It reflects in form of resilience of the businesses, ability of the business to deal with the challenges in the environment. It reflects in moats, which gives sustenance and solidity to businesses to prevail upon any threats and challenges which appear. All of these result in longevity of a business, durability, and which in turn once again improves the value today. To give you one example, return on equity, one of the most important barometers, and which America typically has enjoyed superiority on that metrics compared to all other market economies. And no wonder America in last 30 years has been number one return generating market in the world. India has been number two in last 30 years. And China is nowhere in the picture, though China has grown economy at the highest rate in this period.
Right.
But I'll talk about it later when,
Yes.
if time is there and if there is interest. But it is the quality, the predictability, governance, solidity, character of that growth, return on equity, that is what has made American business growth convert into returns much higher than the underlying growth. Quality is a protective armor. It allows businesses to be protected from vicissitudes and challenges. Quality gives a durability to business. Quality gives ability to businesses to not only grow high, but grow in a right way to add value. That return on equity number for the first time 2020 to 23, India has emerged as number one country in the world in terms of the corporate return on equity. All along, that trophy is held by America. For the first time, India has emerged as number one in that trophy. And therefore, that has a great bearing on the future. Therefore, of the three key levers which build into the value, the growth rate, the durability of the growth rate, and the quality of the growth rate. India is checking all the three boxes and not merely checking, but at a high score. And therefore, I, really speaking, am not unduly perturbed or worried about whether valuations are high. In my opinion, they are not. In fact, if you look at, though Nifty is not a good barometer, or any index doesn't always reflect fully the underlying thrust and the character of economy. But Nifty for the next year is valued at about 23 times. I mean, it's not some bizarrely high number. And historically, over 10 or 15 years, Nifty has been somewhere in that range, some years higher, some years little lower, but not very far from that. Therefore, even on that basis, the valuations are not unreasonable. I, for one, do not necessarily buy large cap because they are large cap, or I buy small cap because they are small cap, or I buy mid cap because they are mid cap. Virtue is not on whether something is large cap or a mid cap or a small cap. Virtue is in whether the management character is right, whether the business character is right to be able to create value, whether the size of opportunity is large. Therefore, in a large size of opportunity, whether a business can create meaningful, durable growth, whether the quality of that growth is superior. Therefore, all of these will convert into value. And if the business is priced today cheaper than the value today, then apart from the earnings growth is a driver of returns, quality of the growth is a second driver of returns, both being annuities. You get a third element, margin of safety, which is one time the gap between price today compared to value today. And therefore, I, for one, would always look for the combination of these characteristics which will create value rather than mid cap being a driver of value or a small cap being driver of value. That is, there is nothing special about size of the market cap to determine what can be category returns in the future. Even over meaningfully long periods of time, if you look at in 10-year alternate cycles, you will find sometimes some index will be doing better, large cap may do better, in some other year, mid cap may do little better. Even if you take a 10-year running cycle, you will find completely random pattern of which index will do well, small cap or large cap or mid cap. So there is nothing special about it. And on a long run, difference between any indices also is not meaningfully very different. So there is nothing special to choose. But I would only say today we are at a fortuitous set of circumstances that there are many quality businesses are abounding, entrepreneurship is flourishing, government is enabling the ease of doing business in a right way. The infrastructure is growing at an unprecedented pace. Technology embraced by government is remarkable. Digital public infrastructure that government has created, including payment infrastructure like UPI, is unprecedented anywhere in the world. With GST formalization, logistics costs being brought down, energy footprint and green energy footprint, India is right at the forefront. And the infra piece of airport, railway, roads, water, unprecedented anywhere in the world. And therefore, many factors have combined where will create that crescendo. And therefore, in the context of that sustained high growth, durable one, predictable one with a superior quality, I don't find valuations out of line. Per se, I don't buy, as I mentioned, large cap or a mid cap or a small cap because it is some cap. I buy for these virtues. But that said, and in our portfolios, typically small cap in particular are relatively small percentage of our portfolios. But even there, I will not say that valuations are aberrant or out of line. Some individual stocks, some individual names may have more enthusiasm and little bit of extra frothiness. But in general, I think market conditions are healthy, economic conditions are healthy. There is greater understanding that it is equity investments which will create value and not fixed income investment or insurances. And long term basis, reduction in the cost of capital acts as a lever for improving valuation of businesses. Any reduction in cost of capital automatically results in improvement in the valuation of businesses, because cost of capital is a denominator while valuing a business. And therefore, a lot of factors combined put together, I will not say that even small caps where lot of comments typically keep getting made, or mid caps, that there is frothiness and too much excitement and too much of these. Some individual names, yes. In IPOs, also some individual names, yes. But in general, economy, market conditions are healthy, and I don't find valuations as defeatist. It may be temporary here and there, but on a 20-year journey and more, I think this is a blip and not very relevant factor.
Okay, great, great. So basically, you more stock specific and bottom up approach in the sense that you're not buying businesses because of the valuation, looking at overall growth aspect and then investing.
Yes.
So, sir, the other question is, do you see some more alignment taking place in terms of GDP versus the equity market, in the sense that, for example, the real estate industry contributes close to 6-7% in terms of GDP growth, whereas the weightage of real estate companies in equity market is half or maybe lower than that, or other way around is banking and financial, which is at 38, 37, 38% of the weight. Do you see some order getting changed because their actual contribution, the GDP perhaps could be 20% or so? So you see that alignment taking place. You are on mute, sir.
Yeah, let me bring that comparison that I talked about. You take last 30 years and take three major economies, America, India, and China. And let me narrate GDP growth rate number, nominal GDP growth rate in dollar terms, and stock market returns for these three places in dollar terms again over a 30-year period. 30 years, America GDP, nominal dollar GDP, America is dollar, so nominal GDP growth rate was 3.8%. And market returns in America have been 9.2%. So GDP grew 3.8, but market returns were well above that 3.8, almost 5% plus higher than the underlying GDP growth rate. Then comes India. Therefore, in America, you got a premium for quality. You got not only GDP growth as a return, but on top of it, 5% plus per annum over 30 years, you got quality premium. 3.8 plus 5.4 gave you 9.2% is the market returns. India, 8.5% nominal dollar GDP growth rate, 30 years, 8.4% market returns. 1 unit of growth, 1 unit of market returns. No, nothing gained more than that, but nothing lost either. Come to China, 13.5% growth rate, 13.5 compounded over a 30-year period. Unprecedented, never in history before. But the market returns, 1.9%. Therefore, America got a quality premium of 5% plus. India got quality premium is zero, neither discount nor premium. Therefore, quality was even, nothing added by it, but nothing subtracted by it. China, huge quality deduction, negative quality of more than 11%. That's where I'm saying that quality of growth is even more important than the just the growth rate. Without earnings growing, businesses can never create value because even in the nature, nothing can remain static. If something doesn't grow beyond a point, then it actually regresses. In markets, it is even more so. If something doesn't grow the earnings over a period of time, the value regresses at a rapid pace. It doesn't just stay the same. But when the quality is inferior, it can do huge amount of destruction. Therefore, China, in order to earn 2% returns from the market, had to struggle to grow economy at 13.5%. That 11% from a poor quality deduction is where the rub is lying. I'm again repeating, there are three vital factors for value creation: rate of growth, confidence about its durability and predictability and solidity, and third is the quality of growth. You need all the three factors, trinity, in order to create value. In my opinion, India, which gained no quality premium, now will actually gain material quality premium because of the reforms and changes that I talked about, where it is visible to the world that why India is a much better place to be in and to do the business than before. In any case, the growth rate of the economy will be well over that 8.5% that we witnessed in last 30 years, the nominal GDP growth rate. Therefore, India has both the aces up its sleeve. Rate of growth superior to last 30-year average. Quality being far better. I already talked about how return on equity in India is now number one in the world. America has now come down to number two position in that. Therefore, India has both kings or the aces up its sleeve. America will find it harder to grow at 3.8% like it did in the past on a larger base. And the quality premium for America definitely will shrink because even American markets are on a narrow base. Actually, if you remove Microsoft and Amazon and Apple and Nvidia and Meta,
Yeah.
7, 8 names, if you remove, in last 10 years, American markets have actually not made any returns. Therefore, American economy also is on a narrow base today, largely riding on technology. And therefore, America will have sufferance on both the count, rate of growth lower, quality premium will be lower. Economy may grow at X, market may give better than X, but not as high as earlier. In India's case, economy will grow at a rate definitely superior to the past, but the quality premium will be much, much higher. And therefore, I have no hesitation in saying that while over a 30-year period, India may be number two market in the world, but over next 10 and 20 and 30 years, India will be number one market in the world and by some margin. China rate of growth is clearly unlikely to be anywhere near 13 and a half. If they manage 5-6%, they will be lucky. And the quality part, as it is, it looks like they're busy damaging their own selves by their all the time actions. Recently, on their gaming companies, they announced some further restrictions, and the market cap was eroded by $95 billion in a matter of 2-3 days. Their entire education space has been wiped out, virtually becomes zero, in which they put in some $150 billion of investment. It has all become virtually zero. So I see major difficulty for China in the growth rate being maintained, unlike impossible. Quality of growth also, there is nothing to indicate whether it will improve. Therefore, India is in the real juicy position. And it is the quality part and longevity part which decides whether economy markets will enjoy a premium, neutral position, or a discount to the economic growth rate. I think America will have discount, India will have a premium, and China could have materially negative discount. These are the probable scenarios.
Wow, amazing. Lot of wisdom, sir. So to have a glass of water sometime, then we'll start. I have a
Yeah.
couple of questions for you. I'll also have some water. Sir, I've been listening to you and you've been talking about value migration since 2015-16. In fact, I had a chance to read your book also. So I remember your first fund that point of time which was launched was, Golden Decade Value Migration. You talked about it. Now, where do you see that migration? You talked about it in 2016-17. As we speak, where do you see whether it happened or not, and where do you see going ahead? Over to you, sir.
No, across the board, I think businesses are getting transformed. Technology, digital public infrastructure, the hunger of the entrepreneurs, the startup ecosystem, new business ideas, new innovations, infrastructure backing them up. Therefore, brand new businesses are being created in the, for example, PLI-led incentivization and new manufacturing ecosystem emerging. Consumers are more aspirational. They want to consume more, newer, better, more hungry to attain it. And therefore, that opportunity also is much superior. You can witness it in automobiles also. No longer it is entry level cars or entry level two wheelers which are selling as much. It is more premium end which is witnessing a better traction. You can see it in the hotels as well. You can see it in the airlines. I mean, business classes run full. I take maybe 12, 15 flights a month. And every time I see the business class fly seats are completely full. Therefore, even in consumption, while consumption will grow for a long period of time at a high rate, but it may not be as much for staples. It may be more for discretionary. It may be for more durables. It may be more for luxury. Those are the kind of consumption patterns which will do well. And therefore, that transition of a successful economy, more confident economy, more entrepreneurial economy, which is what India is, I think the traits are visible. It gets reflected in the confidence in the way we engage with the world also. Reputation of India, the stature of India, clearly today is superior to what it has been at any time in the past. India's voice, India's businesses, their impact, everything of that matters. And that does make a difference. And therefore, these opportunities, these ideas are at the root of changing India. It may reflect in electronic manufacturing ecosystem. It may reflect in logistics businesses. It may reflect in aspirational consumption. It may reflect in more higher end quality consumption, whether in automobiles or durables. It may reflect in services that are being consumed, whether in the travel or tourism, or in the or whatever other services that we talk about. The India is making transition across many of these parameters. And another point that I wanted to make is, if you look at any major economy in the world, actually, there is no other economy in the world which is as diverse as India is. America today, largely driven by technology, very little manufacturing and agriculture merely for its own sake. Really speaking, no other strength in agriculture except inward looking demand that it needs to satisfy. China is substantially in manufacturing and industry, not very strong in services. And on agriculture, actually, China is weak. Brazil, largely agrarian economy, weak in services, weak in even manufacturing and industry. India actually has a meaningful depth and variety of businesses in industry, in manufacturing, in services, diverse kind of services, whether pharmaceutical and research, whether software and technology, or whether advertisement and professional services, all kinds of services. India has deep amount of strength, and India is a agriculture base where productivity is low and can grow. Therefore, India has kind of diversity, which reduces the risk of an economy to grow at a rate for a length of time. India is on a sweet spot, and therefore, when the growth rate of various sectors of the economy combine, they create a larger and rising ecosystem. India is at that sweet spot. Therefore, aspirational, growing India, confident India, entrepreneurial India will create further aspirational growth for itself. Like they say, money begets money. In order to grow more money, you need to start with some money, and therefore, more money, other things being equal, will beget more money. And therefore, confidence, success, aspiration, and its articulation in turn begets more of it. And India is in that sweet position.
Right. So my last two questions, sir, and we'll conclude the call. Um,
Okay.
yeah. The other question is, so what do you think? What can go wrong? What can come as an obstacle on our way going ahead, sir?
Well, you see, there can be nothing moves smoothly. If you look at it every year, every period, something or the other happens. If you look at over last 20 odd years, 2000 to 2002, technology meltdown and huge amount of problem. Markets simply collapse. 2004, market were at a level lower than what markets were in 1992. So after 11 years, markets were still below what they were. Then we saw a period of growth, but not very sound quality of growth. Infrastructure in a haphazard way, capital goods and other areas where haphazard investments, leverage investments, acquisitions within India, outside India occurred. Tata still buying, Tata still buying Chorus and Tata Motor buying JLR and Hindalco buying Novelis, and long period, decade plus, that all of them suffered after those acquisitions. Many things went wrong. Therefore, balance sheets of bank started getting impacted. The effects were the seeds were planted in the period of 2006 to 2000, I would say 9 or 2010. Effects started becoming visible from 2015-16. They reached horrible peak around 2018-19, and therefore we witnessed a huge amount of those bank write-offs and all of that. Then in then we saw in 2009 to 14 general collapse of the confidence in economy and our strength and all of that. We witnessed in 2018 that ILFS episode where ILFS melted down, Yash Bank followed, Diwan Housing and other things happened. Well, entire financial system looked like it will melt and came into threat. 2019, because of these and forced write-offs necessary imposed on the bank, we witness economy slow down. And 2020 COVID, 21 also we remain in the shadow of COVID. 2022 normalcy look like, then the war between US, Ukraine and Russia, and now slowly people were forgetting the new war has emerged. So challenges, ups, downs, twists, turns will keep occurring. Well, sometimes it may come in form of oil prices. Sometimes it will come in form of external challenges. Sometimes geopolitical. Sometimes some other macroeconomic, like America and Russia, America and Europe going through economic challenges right now, and inflationary. I do not particularly worry about any of those. Many of these challenges will come. Some of them will look significant. Sometimes some of them will look daunting, but none of them I'm really particularly worried about. I'll only say one factor which I would still worry about. Why we are today much more confident about our future, our growth rate, our durability of growth rate, and quality of growth rate is because of the reforms and many important economic bold decisions which have occurred over last 10 years or so. The continuity of those changes, new changes to be brought about, maintaining of those reforms and enhancing them is very critical issue, and that is the issue of the leadership. Ultimately, leadership makes a difference everywhere, in a family, in a firm, in a society, in a country. Everywhere, leadership makes a difference. Even in a family unit, which is typically, say, 4 or 5 members in a family, and yet leader of the family being good, not so good, will make a difference in the outcome and health of that family. Therefore, leadership of the country is a very critical, important issue. And I have no political view here. I have zero interest in politics. My interest is only in the prosperity of the country, growth and wealth building of the people, their well-being, and India's pride being achieved for its due place under the sun in the galaxy of all the countries, where India proudly belongs at the top and that it deserves to be there. I'm only concerned with that. And therefore, I believe the current leadership has done a lot to bring where we are. We still have a lot of miles to walk before we can begin to take some rest. And therefore, continuity of these leadership for some length of time is still very vital. And that can make a big difference. Ultimately, a lot of time I hear that irrespective of whatever, India will grow. I think it's a very facile and superficial statement to make. Nothing is automatic. God has not given us benediction that automatically India has to grow. And even if India will grow, difference between 5% and 7.5% and 8% growth is a huge difference compounded over a period of time. And the difference comes from the leadership. And therefore, I'll only say one thing, that leadership which has brought us here, made us more aspirational, made us more confident, we need continuity for some length of time.
Sure. So politically, I mean, we need to see that what kind of risk which emerge in the future. All
Yes.
right, sir. So my last question, because
Great.
there are few investors who are there part of the call now, and they have invested in various AIFs and PMSs. I don't know if you're comfortable. I want to read your mind here. Is that you've been instrumental right from the beginning in terms of defining the investment philosophy, as I said in the beginning. And you have a scheme which has delivered, 18, 19, 20% CAGR for 20, 23 long years. I remember the first PMS which was launched, it was in the year of 2000, and that was growth fund. Now, my question is, how is your current team positioned now, the investment team, sir? And what are you driving as a fund house? And how do you see going ahead? The investors are continue to see the similar history, because as the base becomes bigger, it becomes a little difficult for fund manager to continue to beat the benchmark. What do you say?
Two things are important: absolute return and relative. Both are important. And equally, I'll say capital preservation and capital appreciation, both are vital. Both the twin sets of objectives are very important to us. Absolute return, when we talk about, we are is basically saying that without any fight or argument with Mr. Market, whether you can be confident through your stock selection, through your discipline, your investment process, and through being judicious in allocating capital in the portfolio to the right kind of businesses in a balanced way, managing risk well, can you say you will make absolute positive compounding over a period of time and healthy returns as an outcome? Therefore, to me, the first objective of any investing is to attain that belief and confidence that we will generate absolute, positive, healthy, compounded return without any argument or without any debate or benediction of Mr. Market. If we can't do that, then we are not worth our salt. Second is good investing in any case over a period of time has to produce. uh, Good
Please take
investing
it.
over a period of time has to produce a relatively superior outcome over a period of time, because world is relative, human nature is comparison over a period of time with index or some other benchmark. But I don't see anything wrong about it. Over a period of time, the approach is to demonstrate a kind of a difference. You talked about our oldest offering, which is about close to 22-year-old. It has generated 20.5% return in this period, with a gap over the index of close to 6% per annum compounded over 22 years. 6% may be large. Whether that kind of a number we can maintain, I don't know. But meaningful difference over index of 2%, 3% or more is something possible and we must attain. Therefore, we remain deeply committed to healthy absolute and relative superior outcome over a period of time. Healthy absolute, I'll say, if the economy is growing at 7%, 7.5%, nominal GDP at 11%, 12%, if we don't deliver healthy double digit compounding on a long term basis, then I think it will be our failure. It will have nothing to do with the markets, it will be our failure. Opportunity is fully there, economy is prepared and ready, and we have to harness that opportunity and convert into outcome in the portfolios. So some period may do well, some period may not look very well mathematically speaking, but over a period of time, we will deliver healthy double digit absolute compounding, maybe 15%, 16%, 17% compounded over a period of time. I'm not kind of committing anything, but if we fail to achieve that kind of outcome, I'll be very disappointed. I'll regard it as our failure more than anything else. And equally, along with that absolute outcome, superior relative alpha also is a must and will happen. So both of these we remain deeply embedded and committed to. Much like capital preservation, so that we don't take foolish risk and foolish chances. At the same time, ensure that capital appreciation occurs. Risk management is ensure capital preservation, to take intelligent risk in order to achieve capital appreciation. Both remain important to us. We must preserve capital by our actions, by our discipline, by our selection, by processes, and we must grow the capital. Therefore, both preservation and appreciation of capital are vital and key objectives. Absolute and relative returns also are vital, healthy absolute and superior relative. And we remain committed to all of these in entirety.
Great, sir. Great. With that, would like to conclude the session here. It was absolutely pleasure talking to you. As I said, every time when
Thank
I
you,
get back
Vikas.
with you, I get a lot of insights and a lot of energy. And to hear more from you about India as an economy, I wish I would have continued this call for another 1 hour and get an opportunity to read your mind. With that, I'd like to conclude the session here, and I look forward to meet you in person, sir. Thank you.
Thank you, Vikas.